Ladies and gentlemen, good morning and welcome to the JTL Industries Q1 FY2026 earnings conference call hosted by Nuvama Wealth Management Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touch-tone telephone. Please note that this conference is being recorded. I will now hand the conference to Ms. Neha Talreja from Nuvama Wealth Management Limited for opening remarks. Thank you, and over to you.
Thank you, Dan. Good morning, all. We welcome you to the JTL Q1 FY2026 conference call. We are today joined by the senior management of JTL Industries, represented by Mr. Pranav Singla, Full-Time Director, Mr. Dhruv Singla, Full-Time Director, and Mr. Atul Garg, CFO. We will now start with the opening remarks of the management, followed by the Q&A. I will now hand over the call to Mr. Dhruv Singla for his opening remarks. Over to you, Dhruv.
Hi, good morning, all. I hope you and your families are doing well. I'm Dhruv Singla, Executive Director at JTL Industries, and I'd like to welcome you all to our Q1 Financial Year 26 earnings call. Joining me today are Pranav Singla, Executive Director, and Mr. Atul Garg, our Chief Financial Officer. We are delighted to have you with us today as we share our recent performance, highlights, and strategic developments. For those less familiar with JTL Industries, here's an introduction.
Ladies and gentlemen, we have lost the line of the management. Please stay connected while I rejoin the management. Thank you. Ladies and gentlemen, thank you for your patience. We have the management reconnected. Dhruv, sir, you can proceed.
Yes. Hi, sorry, the line got disconnected. Let me start again. Very good morning to all of you. I hope you and your families are doing well. I'm Dhruv Singla, Executive Director of JTL Industries, and I'd like to welcome you all to our Q1 Financial Year 26 earnings call. Joining me today are Mr. Pranav Singla, Executive Director, Mr. Atul Garg, our Chief Financial Officer. We are delighted to have you with us today as we share our recent performance, highlights, and strategic developments. For those less familiar with JTL Industries, here's a brief introduction. With the legacy spanning over 3 decades, JTL has emerged as one of India's leading manufacturers of steel tubes, serving vital sectors such as infrastructure, oil and gas, water transmission, and construction. A diverse product portfolio includes ERW black steel pipes, galvanized tubes, large diameter sections, solar module mounting structures, and hollow steel profiles. We operate 5 state-of-the-art manufacturing facilities strategically located across India, enabling us to deliver high-quality, value-added solutions with speed, scale, and precision. Our focus on high-margin, specification-driven segments, supported by continuous investments in automation, digitization, and quality systems, continues to reinforce our competitive edge. Equally important, we are advancing our commitment to sustainability through initiatives aimed at improving energy efficiency and reducing our carbon footprint. Moving on to the performance highlights, this quarter we achieved a total income of 5,496 million. Our EBITDA stood at 233 million, translating to an EBITDA margin of 4.3%. We also reported a profit after tax of rupees 165.5 million with a PAT margin of 3%. Sales volume of the quarter were at 108,406 metric tons. Value-added products accounted for 20% of the sales mix, aligning with our focus on higher margin offerings. Export volume stood at 6,404 metric tons for the quarter, which constitutes 6% of our total sales. During the quarter, we initiated plans for the commissioning of a new ASTM API grade pipe market Through these products, JTL will become one of the very few manufacturers in India with the capability to produce larger diameter, higher thickness API-grade EMW pipes, thus placing us in the exclusive league of technically advanced players. This investment will aid in expanding our footprint in high-grade segments such as oil and gas, water transmission, and city gas distribution. These markets typically yield EBITDA margins of 7,000 to 8,000 per metric ton, making this development significantly value accretive. I would also like to highlight that JTL Industries has commissioned production of ultra-thin 0.04 mm brass foil through a strategic job work arrangement, making its entry into a high-value niche segment. Known for its low friction and corrosion resistance, this product caters to sectors like defense, aerospace, industrial electronics, and EMI RFI shielding. The job work model allows cost-effective scalability and quality control by leveraging external expertise. This initiative aligns with JTL's strategy to increase value-added products from 24% to 50% of sales, complementing this investment in DFT technology. Backed by 1,000 plus dealers and exposed to 20 plus countries, and SKUs of 1,500 plus SKUs, JTL is well positioned to grow in specialized high margin markets. I would like to reiterate that the aim behind this diversification is threefold. Firstly, to enter a high demand niche market with limited competition. Secondly, to expand the value added portfolio, which will subsequently secure our margins. And lastly, to diversify across alloys so as to reduce dependence and avoid slowdown during an industry downturn. Not only are we focusing on returns, but also making ourselves as irreplaceable and exclusive as possible. As we are undergoing a heavy capex cycle in the new SKUs, the current margins don't reflect the actual margins the company shall be achieving in future. Going forward, our outlook remains optimistic, considering sustained demand across key sectors, our superior quality, and due to the key shifts in investments made by JTL. I want to reaffirm our commitment to delivering value through operational excellence and strategic expansion. Thank you for joining us today. I now open the floor for your questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Aditya Welekar from Axis Securities. Please go ahead.
Yeah, thank you for the opportunity. So my question is with regard to our EBITDA per ton. So we have seen some underperformance since last quarter. So what is driving this despite our sales volume increasing and VAP share almost at 20%? So if you can throw some light on that.
Hi, Mr. Aditya. Good morning. Thank you for your question. There are two, three factors to the a little slowdown or say a little less EBITDA per ton as compared to the last time that we have encountered. Firstly, we are all aware that the duty was implemented in April 21 and on April 21, 2025. After which there was considerable jump in HR coil prices for the month of April and May, which then again corrected in the month of June. So we did encounter a good run rate in the months of April and May, but then again, due to correction in prices, there was a downturn. So some aspects are related to that. Secondly, we had commissioned our DFT in the month of March. In the first quarter, we had pushed our product across segments of dealer network, OEMs, to the tune of sending material to across borders to Gujarat, North, Middle, South. So to get our product out and about for DFT, so we had to take certain pricing dips in that segment and take a hit so that our product is known in the market due to that. we were waiting for certain, since it was the first quarter that the machine was up and running. We had taken some hit because of we had to get the BI certification, the C certification done, and so there was a little hit in that segment. So all in all, these were the few factors which had pulled down the EBITDA per ton. But this is not a continuous factor. We have seen good demand going forward in DFT sales for value-added higher thickness as well, since now we have the certifications required for the same. So yes, going forward in the next quarters, we will see a better realization in those terms as well.
Okay. And if you say about the sales mix, that currently whatever DFT pipes we sold, they're technically smaller than size ranges, which we didn't include in VAP category. Once those products are in the size which get VAP margins, they'll be included in that category, and the VAP share will go up accordingly as well. So we'll get the VAP margins accordingly, and we'll include the products in that category itself, that time itself.
Understood. So going ahead from Q2, can we expect that means our EBITDA per ton, means we have a full year guidance of 4,000 rupees per ton, and then our full year VAP share is guidance is 40%. So are we on track to hold this guidance going forward?
Yes, we are on track to hold the guidance still intact as well. If I just mentioned that if you did 8,000 tons of sales of DFT pipes in Q1, those were included in general category. Going ahead, those 8,000 tons, when they will give us a margin of 6,000, 10,000 rupees EBITDA per ton plus, they will be constitute toward VAP as well, which will make the VAP share go in a higher percentage as well. And at the same time, will increase the EBITDA per ton as well. So all in all, those factors will bring up whatever you're asking for.
Okay, so you are holding 4,000 rupees per ton EBITDA guidance for 26, and for 27, any color, because we have introduced DFT, and then our color coated lines, this Mangaon facility, as you have stated in the presentation, this ARW API grade GI coil. So all this will earn higher EBITDA per ton. So any color on EBITDA per ton trajectory going forward in 27?
See, the thing is, as all of these products are new for us, although the peers are commanding a very high EBITDA per ton on them, but as the situation happened in DFT, to start circling the products in the market, we have to take a hit on the margins in the beginning. That might happen once we lose those products as well. But eventually, once everything is established and up and running in a proper way, we will get a much higher EBITDA per ton. But to guarantee what kind of EBITDA per ton we'll be getting in FY27 Q1 or H1 of FY27, that is something that we're not even clear about right now ourselves as well. Going ahead, as the production picks up, as the certifications are received, and as the product is spread in the market, we will be able to command a higher EBITDA. That is something that we can guarantee. But in quantifying the amount right now, because of the whole situation, at times the duty being applied as well and external factors as well, we are not very clear about what kind of EBITDA per ton we can do.
Yeah, to add to that, there are a lot of contingencies, as Pranav said, in the market that we have to take care of. So we would be able to say a minimum of the guidance that we already provided. But say the contingency right now, we had implemented the DFT, thought of opening newer markets of USA, Canada, which now due to Trump tariffs are not, nobody's interested or nobody's looking at buying material from our markets. So everything is on a wait and watch scenario. So we have to live with that scenarios and wait for things to get better.
Understood. And anything on volume front? Means we were targeting 5 lakh tons in 26. Are we confident to achieve that?
Yes, we are very confident to achieve that. We should be in a range bound of say 5 lakh tons, given plus minus of a normal margin there. We should be achieving that.
Understood. I have a few more questions, but I'll get back in the queue.
Sure.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and one. We take the next question from the line of Amar Maurya from Lucky Investment. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. A couple of questions from my side. Firstly, can you give me the volume breakup between the GI, DFT, and GP? Okay, 1,08,000, whatever.
Yeah. Hi, Mr. Amar. So, right now, to answer your question, we don't have GP pipes. We only have the GI and black that we are categorizing into two categories. To start off with, in this quarter, this is the first quarter we had our DFT product on sale. And as we mentioned earlier, we have not categorized this into a value-added format. So we have not done that. So to answer your question in a plain manner, the 22,000 tons of value-added products that we've done is majorly galvanized pipes. And the DFT is included in the normal range of products as of now, which was to the tune of about 7,500 to 8,000 metric tons for this quarter, for the first quarter.
Okay. 8,000 you are saying DFT out of 22,000 value added, correct?
No. 22,000 value added is galvanized alone. 8,000 DFT is in the normal range of products that we have.
Galvanized
Because in the general category.
Galvanized will come in a separate category?
No, so how we define our VAP is, under the VAP, we include products which give us a EBITDA per ton of 5,000 rupees plus, which is generally galvanized pipes for us since beginning. As we have just on DFT right now, we were not able to include DFT in VAP category because it didn't give us a margin of 5,000 rupees EBITDA per ton. Once the product gives us a margin of 5,000 rupees plus, the DFT sales, which was to the tune of 7,500 tons in this quarter, will be added to the VAP category.
So basically, you are saying GP is basically 22,000, correct? And DFT 8,000.
We make GP pipes right now. Galvanized iron pipes is what we make, which is in the VAP category.
Correct. Galvanized pipe GP is 22,000. DFT 8,000, which is into general category. And rest all is basically GI pipe, GI and black pipe, correct?
No, sir. No, you are confusing the entire scenario. We are not into GP pipes. Pre-galvanized pipes we are not making. We are making two kinds of products. First is the galvanized iron pipes, GI pipes, that is galvanized after making the pipes on zinc coating on top of black pipes. Okay. That is 22,000 tons. The rest is the general category black pipes that we have made, which includes DFT at the moment of 7,500 tons. This is what it is.
Galvanized iron pipe is a part of value added, and galvanized black pipe is a part of general. And in that,
there is no galvanized black pipe, sir.
So, black
there is only black pipe.
Normal black pipe. Okay. Okay. And secondly, sir, in terms of your EBITDA per ton, is there some impact of inventory loss also included into your EBITDA per ton of 2,000 rupees ton?
Yes. As I mentioned with the question of Mr. Aditya Velikar, the first 2 months after implementation of the duty, we saw a sharp increase in prices of HR coils. In the third month of June, we saw a correction in prices. So in third month, there was inventory losses related to the decline in prices after the sharp increase.
Okay. And how much more impact do you think your high cost inventory can impact? And normally, what is your buying pattern? How do you basically buy the inventory? If you can help us understand, because see, normally these kind of fluctuations will be very common, right? But if we should be able to hedge this? I mean, what is our policy? How do we buy the inventory so that, we are immune from all these scenarios?
So, the black coils or HR coils or iron is not a commodity that we can hedge. First of all, it is not a non-ferrous product.
You cannot hedge, but I'm saying,
yes.
How do you
So normally we are sitting in Q1 and we are looking at Q1 results at the moment. Normally it's a cyclical industry. The Q1 and Q2 are fairly slower than Q3 and Q4. In the Q1 and Q2, we encounter monsoon. We encounter fluctuations in the market scenarios wherein the prices can go up or go down as well. So here, when we look at the entire year of a normal steel industry, we see that these losses on inventories or gains in inventories set off each other in the 4 quarters that we have. Because in some quarters there will be losses on inventory, in some quarters there will be normal gains as well on inventory. So that is how the entire year looks at. So, and to answer the second part of your question about hedging, when we are producing a value-added products, that is against orders, so that has a normal hedge. We have 4 categories of our products that we sell into the markets. First is the government sector, second, export segment, third, the OEM, and fourth, the dealer network. Dealer network makes the most of it, which picks the material from the stock. So we have to maintain an inventory to sell, say, 1 lakh tons of material in a quarter. We have to maintain an inventory at different locations of at least 25 to 30,000 tons of material that keeps them rotating on a daily basis. So we don't have a natural hedge in the 50% of the material that we're making, but all the government sectors or export segment, or we buy material only against order, and we have some price variation clauses as well that we are hedged against the fluctuations in the market scenarios. So that is what.
But sir, dealer network is not common. Your peers are also having more than higher distribution network than you, right? And they are managing it. So basically what I'm trying to understand here is that and going forward, your intention will also be to penetrate more distribution network, right? But then you cannot give the argument that distribution network is high because of this, you have to suffer the fluctuation. This is not visible in other PNL. Why?
No, that is what not I'm saying, sir. I'm saying this is how we categorize our products into and sales into. Every company has their different modes of sales, and this is how we are working on top of it. That is what I said.
Sir, what I'm saying here is that, sir, लोहे का fluctuation तो हम कभी भी ले नहीं सकते, right? So what I'm trying to understand, if you say that you have 50% distribution network and you have to stock the inventory for that, so any fluctuation in the inventory, why you are taking it? It has to be passed on to dealer.
That is what happens. I'm not saying the entire 50% is stocked and inventory losses come on that.
Correct.
A lot of material in that is sold and a lot of material in that is unsold. We only get the fluctuation on the unsold part.
So sir, unsold part, so basically unsold part, so you are saying unsold part you are accounting it, then it can reverse, let's say once you sold it?
Yeah.
So I didn't understood, sir. This is the accrual accounting method, no? Sir, आप जो बेचते हो उसका ही रेवेन्यू और उसका ही कॉस्ट बुक करोगे ना, जो नहीं बिका उसका कैसे आएगा?
उसकी बहुत इन्वेंट्री प्राइस तो कम हो गई ना आपकी. अगर आपकी कॉस्ट एक्सेस क्वालिटी पहले थी ज्यादा, उसका रेशो की प्राइस नीचे हो गई है, उतना ही तो मेरे को इन्वेंट्री में मेरा आएगा ना.
I didn't understood.
सर, अब आज मेरे पास 1000 टन माल पड़ा है, उसके अंदर मेरे पास 1000 टन माल 100 रुपए पे लिया हुआ है. आज मार्केट 90 रुपए हो गया, तो 90 रुपए पे अगर मैं माल बेचने जाऊंगा तो कुछ माल मेरा 100 रुपए पे बिका होगा, बाकी माल तो मुझे 90 रुपए पे बेचना पड़ेगा ना.
So what was your inventory loss currently in this quarter? How much was the actual number of inventory loss which you had booked?
It's close to 1,000 rupees EBITDA per ton, which is in the overall loss of schemes.
Sorry?
It is close to 1,000 rupees EBITDA per ton in inventory loss.
1,000 rupees inventory loss was there in this quarter. Okay. Per ton. Okay. And secondly, in terms of your capacity, when you say you have a capacity of 22,50,000, and so how much is the pipe? In one side you mentioned pipe capacity is 9,36,000. So what is the difference of this? What is this? Is color coated sheets? Hello.
Boss, we have given a full breakup of our capacities, what we have
No.
on our presentation. We can be left to the presentation and get back on the questions. Can you please move to the next question?
Sure.
Thank you. We take the next question from the line of Vishal Dudwala from Trinetra Asset Managers. Please go ahead.
Am I audible, sir?
Yes, Vishal, please go ahead.
So my first question is, revenue per ton fell from 56,000 to 54,000 on Q-on-Q basis, despite higher volume. Which end market saw the sharpest price drop?
Sir, can you come again? The last portion of your question was not clear.
Okay. So let me repeat it. Revenue per ton fell from 56,000 to 54,000 on a Q-on-Q basis, despite higher volume. Which end market saw the sharpest price drop?
Yes.
So, firstly, our revenue per ton is on a blended basis. If you see, as compared to the last quarter, our black sales have improved, and we have made more sales in a black quantity. So this 56,000 and 54,000 is a blended number of the galvanized and the black pipe together. So when we see our increase in quantity in black pipes, this number would fall. So in this quarter, our value-added products remained to the tune of 22,000, which was similar to the last quarter. And but then we had more sales in a black pipe. So that is one of the major reasons for the fall in net realization of this. And then, however, from the last quarter, in this quarter, the prices of HR coils had increased, but this was the major reason of fall in prices. The net realization, like you said.
And the second question is, like, once your new GI cold line and 30 kiloton per annum API grade ERW plants are fully ramped, how do you expect per ton realization?
So your voice cracked again. I'm sorry.
Okay, let me repeat. Your new GI coal line and 300 kiloton per annum API grade ERW plants are fully ramped up. How do you expect per ton realization to trend?
So, see, after this is a scenario of by the end of year, we'll be only seeing the quantities of these two coming in by say the first quarter of the next year. Something would come in the last quarter as well. So the certain realization for the same shall trend onwards, but again we have to put in this material, as we mentioned earlier. We have to put in this material to the market test and penetrate into the new markets that we are not presently available in or present in. So we have to probably we'll have to penetrate by giving a higher amount of discount than our competitors in this market. So it's safe to say that we'll be having a higher net realization, but not just on the fully ramp up. We will have to take another 6 months for this to ramp up in the next year to the full capacity, and then we will be able to answer your question related to this. If we talk about the present scenario, we can see a net realization going up to about 2,000 to somewhere between 2,000 to 3,000, but that is according to today's scenario.
Okay. Got your point. Like, I will wait in the queue for the next question. Thank you for now.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Jyoti Singh from LIC Mutual Fund. Please go ahead.
Hello. Hello.
Hello.
Yes, Jyoti, please go ahead.
Yeah. Yeah. Hi. Actually, just wanted to know, last quarter, when I asked that there was a rise in steel prices, but we did not see any sort of benefit coming in Q4. You had told that will come in Q1. But in this quarter as well, we are seeing that blended realization is down. Also, the EBITDA pattern has been hit. So what has happened totally? Where are the benefits? In fact, there is an inventory loss. So can you explain the entire thing that has gone to it?
Hey Jyoti, hope you're doing well. So basically in this quarter, the first 2 months, the HRC prices were on a rising trend. When we were able to encash everything, and the average realizations were higher as well. But by the end of the quarter, or by, it's safe to say in third month of the quarter, the prices were taking hit. The prices fell by around 3.5 to 3 rupees per kg of HRC. Eventually, the hit came to us as well on the same ratio. So because of those situations, whatever gains one realized in the first 2 months of this quarter, those were offset in this quarter itself, and eventually turned out to be losses.
And to answer your question about the blended realization, as I mentioned in the last question as well, the blended realization is a take of the black and the galvanized together. So in the last quarter, we did a higher galvanized pipes, and this quarter we did 22,000. Last quarter we did 27,835 value-added products. So the blended realization is, and we did a higher quantity as well in this quarter as compared to last quarter. So that is what the blended realization entails. So if and when our value-added products will go up, it will increase the blended realization, and then the decrease in the same will decrease the blended realization.
Okay. But what led to the rise in cost, and how is this getting into? Because your other expenses has reduced. Earlier, I was on the intention that because you commissioned the DFT technology, so that must have dented sort of EBITDA. But there also we see that other expenses have been in control. So what has gone into it? Only just the cost of raw material increase?
Yes, ma'am. You're talking about the blended realization or EBITDA fall?
EBITDA fall, because the other expenses has also come down. So earlier I was of the view that because you have commissioned the DFT technology, so there is a possibility of the expenses going up, but that is also under control. But still the EBITDA is down.
Yes, ma'am. There is a two-factor relation to that. Firstly, the third month of the quarter, we saw correction in prices. The prices fell, and there was an inventory loss of 1,000 per ton, as Pranav mentioned in the last question that we were speaking about. And secondly, to push our DFT sales, we had to get our product out and about. We are normally serving only the Maharashtra region from our Maharashtra plant and some places of Gujarat. But to get up the DFT product out and about in the pan-India basis, we have sent the product to Gujarat, North, MP, Chhattisgarh, South. So all these areas that we have obviously had to pay higher freight, and also give special discounts to get our material to the floors of these dealer networks. So that is what the DFT realization has not kicked in yet. So there is where the lag is.
So what sort of increase in the DFT volume can we see in coming quarters, and how will this get offset? Like, because now if you have given the discount, will this be continued for the next quarter as well, or there will be normally what should be the realization when it comes to DFT product for APL? Oh, sorry, for JTL.
And DFT, DFT is this is not say a basic structure of DFT realization that we should think and take into note. It's a completely new product for JTL. We are earlier producing majorly galvanized steel pipes, black pipes, and those segments. Now there is a certain overlap of segment DFT and in the lower thicknesses and in the higher thicknesses where there are higher margins. We are penetrating into that market. In the next 2 months, our target is to get to those markets wherein there are higher realizations, which include penetrating into EPC and contractors for various bigger projects with higher thicknesses. So going in the next quarter, we will have. This quarter we did about 7,500 tons. Our target in the next quarter is to double this capacity sales, and in the forthcoming quarter, then again have a similar run rate. So going forward, it's not a normal factor of the discount that should be prevailing in the market, but yes, we'll be taking more conscious decisions to penetrate into the EPC and contractor market for various projects that there are.
Understood. Okay. So any guidance in terms of FY27? I think I missed it earlier. There's a possibility they might have asked. What is the guidance for volume as well as the EBITDA per ton for 26 and 27?
The guidance for this year is we'll stick to 5 lakh tons of sales volume. And the guidance for the next year is that we'll do 30% growth over 5 lakh tons sales volume this year.
And EBITDA?
Again, Jyoti, the EBITDA per ton is a tricky question for us right now because we are undergoing a heavy CapEx cycle. So as and when those products convert to the sold market, those margins will come to the range of 4,000 rupees EBITDA per ton that we mentioned. But for now, as it is a transition phase for the company with new CapEx on board as well, it's tough to comment on the exact EBITDA per ton. Our target eventually is to reach a EBITDA per ton of in FY28 of 5,000 rupees plus. That is something safe we can be assured of.
When can we expect the DFT to ramp up completely?
Ma'am, in the next 2 quarters, we are seeing at least a 50 to 60% growth in DFT sales. So ramping up complete capacity is still a bigger question, depending upon various market factors, as we mentioned earlier. Due to export markets, we were contemplating opening of the US and the Canadian market with the DFT segment, but due to Trump tariffs being implemented in these past months, and nobody having any clear indication of the same, we were not able to enter those markets. So we still don't have any clarity on these factors. So giving it a full fledged capacity utilization is a little tough for us to say right now. But we are on the ground working on our capabilities to increase our sales in the domestic as well as the export markets in the same.
Okay. Yeah, that's it from my end. Thank you.
Thank you. The next question comes from Ajit Sethi from Eco Quantum Solutions. Please go ahead.
Thanks for the opportunity. So I just had one question. The demand for ERW pipes, domestic demand is 9 million tons, and the domestic capacity is around 13 million tons. So why we are expanding in ERW pipes?
We are not exactly expanding in the same capacity that we already have. We see ERW pipe segment is a very less research segment upon the data that you have. We exactly don't know how well corroborated that is, to be really honest and not to offend anybody here. But if you see our expansions that we are doing are not only in the ERW segment. We are when we expanded in DFT, it was the structural steel segment, which is replacing the angle channel girders. Now, the second set of expansion that we recently announced is the API grade, which goes into oil and gas segment, water transportation segment, larger dia pipes. We are expanding the SKU range. We are not expanding specifically the SKUs that we were earlier producing. Second part of our expansion is the sheeting or the pre-galvanized CR coils, pre-coated coils, this segment. So which is not exactly related to the ERW segment, is used in making various type of ERW pipes, which is pre-galvanized pipes, coated pipes, open sections. So that is a different area of expansion.
Okay.
Thank you. The next question comes from the line of Lokesh Kashikar from Smith Institutional Equities. Please go ahead.
Yeah, hi, sir. Good morning. A couple of questions from my side. The first one is basically on the realization front. You said that the third month in the last quarter was basically has been under the realization has been subdued because of which we have to realize inventory process. So how has been the scenario right now? Has the prices have been picked up, and what EBIT or inventory carrying process we expect to going to carry on basically in quarter two? Hello.
Yeah. Hi, Mr. Lukesh. So the realization per metric ton, as we tried to explain earlier, is due to a blended realization of value-added and black pipes. So wherein value-added in the last quarter was higher than value-added in this quarter, and we did more sales in black pipes this quarter. So the net realization has decreased, even after certain increases in HR coil prices. Now, to come to the second part of your question of how do we see this quarter going forward. In the last month of June and this month of July, we've seen correction in prices continuously, specifically due to the preset of monsoons and having less demand in the market thereof. The same would be reflected and would be, I think, available in the news with the companies like JW, Tata, etc., them offering certain price indications on the HR coils. We can say that there was inventory losses in the last month of June, and this month, since we've been buying newer products at the newer prices, so they will be subsiding in this quarter, and going forward, we will have to see how the next 2 months are due to the monsoons and the demand thereof. But as of now, we are having a continuous run rate of what we did in the last quarter. So hope there is a good chance we are able to achieve the similar amount and exceed the same as well in the coming quarter in terms of volume. So that is what our outlook and guidance is.
But sir, on EBITDA per ton, is it fair to assume that the some old inventory having higher prices is likely to have some impact in quarter two, due to which we can expect some subduedness in EBITDA per ton in quarter two, and thereafter it will rise in quarter three and quarter four with rise in demand? Is it fair to assume?
We are only carrying our inventories of about 20-25 days. So whatever major inventory loss had to come, it came in the month of June. Now, as I said, we are purchasing new inventory in July. So those continuation of losses will not be prominent in this quarter. So going forward, we shall be maintaining the outlook of a better EBITDA per ton in this quarter.
Sure. And secondly, sir, we have recently basically commissioned our capacity basically on the DFT lines in Mangaon plant. So you have already said that some traction has been achieved, and we have sold around 7,500 crores of metric tons of volume in Q1. But you have already said that you have sent some products in the region of Gujarat and other places. So just wanted to know how has been the acceptance over there of our product, and where do you see that the demand to come from that area? And secondly, when do you see that the realization on the DFT products to achieve around 5,000 metric per ton or that kind of EBITDA per ton?
So the initial motive to send materials to dealer networks all around India was to showcase our product, and the acceptance has been phenomenal since it's a state-of-the-art machinery that we put, and acceptance has been phenomenal. That is the reason we are capable to say right now that second quarter demand, we are experiencing higher demand in second quarter. To add to this, when we supply to the dealer network, we are supplying for a lower thickness scenario there, which eventually is going for construction of buildings and replacing segments such as channels, I-beams, girders. So that is what the replacement is of this pipe. So there has been a considerable push with the dealer networks to replace them. Going forward, now we commissioned our higher thickness slitting line as well in the last month. We are capable to supply thicknesses up to 14 mm. So now we are targeting the EPC contractors and affiliations to organizations like BMC, MMRDA, wherein we will be capable to supply to projects like metro, railways, and airports. So and also the building projects of multi-story buildings. So this is when we are able to supply to the project sites. This is where the EBITDA per ton margin will kick in. So that is what we are currently penetrating into and endeavoring for.
Okay. And so some last question. So basically, our interest costs have almost doubled on quarter-on-quarter basis. So why is it so? And what is our gross debt number? And the capex we incurred in quarter one, and what we envisage for FY2026. Yeah.
So interest cost is double.
There is only a increase in interest cost. I think it's not double if you look correctly, and the major increase in interest cost has come from subsidiary of clubbing of a subsidiary which is JTL Engineering, and in first quarter we did a capex of close to 50 crores, and we'll be having the same run rate of 50 crores per quarter, or somewhat a little more in the last quarter for this financial year.
Okay. But sir, is it fair to assume that the run rate of 2.7 to 2.8 crore of finance cost to continue ahead on quarterly basis?
Yes, it's fair to assume this.
Okay, fine. That's it. Thank you.
Thank you. The next question comes from the line of Prathamesh Diwar from Tiger Asset Managers. Please go ahead.
Yeah, sir, just one question. So did you mention that we are going to grow our volumes by 30% in FY27 as compared to 26?
Yes. We will grow our volumes by 30% plus by next year.
Okay, got it, sir. That's it for me.
Thank you. We take the next question from the line of Ajay Kale, an investor. Please go ahead.
Yeah. My question is, what is our outlook for quarter two FY26?
For this quarter, we're targeting
in terms of units, in terms of volume.
120,000 tons is a safe target for the volume that we have for this quarter.
The numbers, because in last meeting you said you will divide 5 lakh metric ton, mainly first half will be 2.5 metric ton and the second half will be 2.5 metric ton. So this quarter we achieved 1.08. So if I add 1.2, then we will miss the volume target. So why are we planning the lower volume for this quarter?
No, this is a safe target for us. Obviously, our aim is to achieve a bigger number than that. And when I mentioned last year, the average run rate for this, I was saying in this way that our capacity expansion, which will be the part of our GP calls is coming in third quarter, which will be increasing the volume flow as well. So the run rate, how it will happen is, if we miss out some volume of 2.5 lakh tons in Q1, we will end up covering a much more bigger number than that in H2.
See, I understand. Typically, the future always looks bright, but why we can't achieve the numbers 2.5 metric tons? So is there any specific reason? Is it the ground inventory? Is it demand, or is there any other thing which is?
No, it is just ramping up our capacity. We are ramping up our new DF capacity mentioned a few quarters. So if I'm saying that we sort of 2.5 lakh tons by 10,000 tons in Q1 or 12,000 tons in H1. So it's not even a 5% gap that I'm talking about, which will eventually come up in H2. Anyways, if you talk about the growth quarter on quarter, and we're able to do 30% growth this Q1 and year on year 20% plus growth as well. The growth rate will just be on higher ranges, irrespective.
Yeah, I completely get that. So I'm not concerned about the growth. I'm more concerned about the outlook or the planning that we are projecting for the full year basis. Are we strong enough to ensure the volume gets delivered? And the second,
yes, sir, Mr. Ajay, we are confident enough to deliver in the range of 5 lakh tons. It is a lot of contingencies come up with, as we've been talking since the beginning of the call, with the price fluctuations, with the tariffs, with deliverables and DFC, etc. So these contingencies are prevalent at the moment. So our target is obviously higher than what we are currently considering. The 1,20,000 tons plus 1,08,000 tons that we did in the first quarter, 1,20,000 tons we want to do in the second quarter is the bare minimum that we have mentioned here. We are obviously not going to stop at 120 or 108,000. Yet our target is much higher. These things kick in as and when our capabilities and our markets are better. So put it out there, 5 lakh tons is the target for the year. Our target is to achieve 225 for the H1 and the balance in the next quarter, while kicking in our new capacities of the GI coils, last quarter color coating coils. So that is what the target is.
Yeah, I get that. Thanks. Second question is, what is our split between distribution led business and the direct business? And what is our ground inventory in terms of volume as far as distribution is concerned?
So distribution-led business is around 50 to 55% that keeps on fluctuating according to the distributor demand. We do not hold any unsold stock at the distributor floor. So how it works in our business is that everything that is sold to the distributor is the distributor's inventory and not our inventory in his stock.
I get that point. What I'm trying to tell you is that in order to have, since you are more than 50 or close to 50% is the distribution-led business, how is the ground inventory for your distributor? Do you have the tracking mechanism of your distributor's inventory?
There is no margin sharing that we have with the dealers. Once the product leaves the factory, the product is sold for us. There is no margin sharing or share sharing that we do with the dealers.
I understand what you say is that how we have that you need to ask what percentage of our product is a dealer keeping.
Yeah. So my say is once the particular month is over, what is the ground inventory that your distributor takes? Because basis that you can actually assess the demand. If say for example, if he's having 1 lakh metric ton inventory at the closure of June. So what in that sense, what is the inventory? Because basis that you can have the better projections or you can assess the market demand better, right?
So that is majorly the distributors are not listed entity; they are all private entities. We only get to have macro level data from our marketing people present on the floor at various distributor levels. So getting a sense of how full the dealer stock is, what makes us understand how the demand for the next quarter is going to be. Say it depends upon now it's a very open market regarding the prices, and a dealer is not only procuring ERW pipes. So there are building product dealers who are procuring angle channel girders. They're also procuring sheet. They're dealing directly for HR coils with the companies like JSW, Tata. So all these mechanisms also inform them about what the price trend is. So when there is a correction in the market, the dealer stock also declines, and we see that happening on a quarter correction basis wherever there has been a correction. So the demand they shift to a back-to-back demand basis when the price correction happens. But when the price increases, then that is where the dealer starts stocking up. So this is how the basic mechanism of the market on the dealer front is. However, the OEMs, they know this is the minimum quantity they need to produce, so they have a fixed demand per month basis.
Sir, I get what you just said, but still my questions remain unanswered. So, is there any mechanism by which we have the inventory of our product? I'm not concerned about the other companies' product. Our product, whatever we sell to our distributors, do you have the mechanism to?
No. So we don't. Nobody has that mechanism in the market. I believe we don't have that mechanism to know how much of our product is unsold on his, because the products are common. If you do not see the stamping on the product, we can't get to know if it's APL Apollos or JTL. So that is not visible from the naked eye.
Okay. Yeah.
Thank you. We take the next question from the line of Aditya Velekar from Axis Securities. Please go ahead.
Yeah, just a couple of questions. We have seen that means this capacity we have slightly raised it upward from 20 lakh from earlier target of 20 lakhs to 22.5 lakhs. So from funding perspective, we are comfortable, right? Means we are not planning any additional funding.
No, we are not planning any additional funding right now.
Okay. And our full year capex guidance, I think I missed on that. So it's near about 240 to 50 crores for 26, right?
Yes, that's right. It can be plus minus 10% as well, given on the machine as it is, but it's in the range of.
Understood. On the exports, when I asked earlier, so you were seeing some Trump impact of Trump tariffs and also we have a target of 10% exports for FY26. And so how do you foresee that area? Means, do you see some headwinds emerging for our DFT products or other products in exports market?
Aditya, for the certifications of the CE certification, we just got the new CE certifications for our DFT products in the first quarter by the end of May. So right now we are offering our products in the European market. There is no demand from the American market or the Canadian market because of the tariffs at the moment. So we are still waiting those markets to open up with the settlement of the various the tariffs that Mr. Trump has to impose. So going ahead, our target still remains 10% or under 10%, just below under 10% for the export markets. We certainly, with the new certifications, newer buyers and the markets will open up in the European segment, the African and the Australian segment as well. We are working on the same, and the next 6 months will be shall give us more clarity on how we are positioned to sell our DFT products in these markets. We are on track as per the last year for our galvanized pipes product exports that we have already seen with the current exports that we did in the first quarter.
Understood. Thanks a lot. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question and we conclude the question and answer session. I now hand the conference over to the management for their closing comments.
Hi everybody. Again, thanks a lot for your time and your will to come out and listen to us for our Q1 results. Well appreciated. See you in the next quarter earnings calls. Thank you.
Thank you. On behalf of Nuvama Wealth Management Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.